The Great Depression is remembered as America's darkest economic hour, a catastrophe that destroyed lives, shattered fortunes, and left millions unemployed, hungry, and desperate. And that narrative is absolutely true. The human suffering was immense and real. But what gets lost in our collective memory of breadlines and Hoovervilles is a more complex and surprising truth: that the Depression and the policy responses it forced into existence actually laid the groundwork for the most prosperous and equitable period in American history, the post-war decades when a single income could support a family, when union workers could afford homes and college for their kids, when the gap between rich and poor narrowed to levels not seen before or since, when America built the most robust middle class the world had ever known. And this wasn't some natural evolution or inevitable progress. It was the direct result of how the crash demolished the old economic order and forced the creation of new institutions, regulations, and social contracts that would redistribute power and wealth in ways that would have been politically impossible without the crisis. The Great Depression didn't just destroy the old system. It created the space for something genuinely new, something that would give ordinary Americans a share of prosperity that the Gilded Age and Roaring Twenties had reserved almost exclusively for the wealthy. To understand how catastrophe became opportunity, we need to start with what actually broke in 1929, and it wasn't just stock prices, although those fell spectacularly enough, dropping nearly 90% from peak to trough. What really shattered was the entire ideological and institutional framework that had governed American capitalism since the Civil War. This framework assumed that markets were self-correcting, that government intervention was harmful, that inequality was natural and even beneficial because it allowed the most capable to accumulate capital and invest it productively, that workers should be grateful for whatever wages employers chose to pay, that unions were dangerous conspiracies against economic freedom, that social welfare was socialism, that banks should regulate themselves, that the business of America was business and government should stay out of the way. These weren't just ideas. They were the foundation of policy, enforced by courts that struck down minimum wage laws and child labor restrictions, by politicians who broke strikes with violence, by a culture that celebrated tycoons as heroes and dismissed poverty as a personal failing. And the Depression revealed with brutal clarity that this entire worldview was catastrophically wrong. The crash itself began on Black Thursday, October 24, 1929, accelerated on Black Tuesday, October 29th, and then just kept falling. But the stock market crash alone didn't cause the Depression. What turned a financial panic into a decade-long catastrophe was the policy response, or more accurately, the lack of one. President Hoover, who was actually more interventionist than his reputation suggests, still operated under the assumption that government couldn't and shouldn't do much. He encouraged voluntary cooperation between businesses, urged people to maintain spending, authorized some public works, but rejected direct relief to individuals as a dangerous precedent that would undermine character and create dependency. Meanwhile, the Federal Reserve, led by people who believed in liquidationist theory, actually tightened monetary policy, allowing the money supply to contract by a third as banks failed. Thousands of banks collapsed, taking depositors' savings with them. Businesses that couldn't get credit closed their doors. Unemployment rose from 3% in 1929 to 25% in 1933. Industrial production fell by nearly half. International trade collapsed, and the spiral fed on itself. Job losses meant less spending, meant more job losses. Bank failures meant less credit, meant more business failures, meant more bank failures. And through it all, the guardians of the old order insisted that this was necessary medicine, that the system needed to purge the excesses of the 20s, that interference would only prolong the pain. But the pain became so severe and so prolonged that it broke the political consensus that had protected the old order. Hungry people don't care about economic theory. Desperate workers will support politicians who promise change. And by 1932, the country was ready for something radically different, which is how Franklin Roosevelt won the presidency in a landslide despite offering only vague promises of a New Deal, without much specific detail about what that meant. What Roosevelt understood that Hoover didn't was that the crisis had created a mandate for experimentation, for trying things even if they violated economic orthodoxy, for using government power in ways that would have been unthinkable just a few years earlier. The country needs bold, persistent experimentation, Roosevelt said. It is common sense to take a method and try it. If it fails, admit it frankly and try another. But above all, try something. And this willingness to try something, anything, to provide relief and restart the economy would transform American capitalism in ways that persist to this day. The first 100 days of Roosevelt's presidency saw an explosion of legislation that rewrote the rules of American economic life. The Emergency Banking Act stabilized the financial system by declaring a bank holiday, examining banks, and reopening only those that were sound. This sounds obvious now, but it was revolutionary then. The government taking direct responsibility for the banking system's integrity. The Glass-Steagall Act separated commercial banking from investment banking, created the FDIC to ensure deposits, and imposed regulations on financial institutions that would prevent the kind of speculation that had inflated the bubble. Suddenly, your bank deposits were guaranteed by the federal government. Banks couldn't gamble with depositors' money, and the financial system had adult supervision. These changes didn't just address immediate crisis. They created stability that would last for decades. There wasn't another major banking panic until the savings and loan crisis of the 1980s, after many of these regulations had been weakened or repealed. The Securities Act of 1933 and the Securities Exchange Act of 1934 revolutionized how stocks were bought and sold, requiring companies to disclose accurate information about their finances, prohibiting insider trading and stock manipulation, creating the SEC to enforce these rules. Before these laws, the stock market was essentially a rigged casino where insiders routinely defrauded outside investors. Company financials were often fictional, pump and dump schemes were common, and there was no regulatory authority with power to stop it. After these laws, the American stock market became the most transparent and trustworthy in the world, which would later allow it to channel investment capital efficiently and help fund the post-war boom. Again, a crisis-driven reform that created lasting benefits. But the financial reforms, while important, were just the beginning. The real transformation of American capitalism came through labor law, social insurance, and a fundamental rebalancing of power between workers and employers. The National Industrial Recovery Act of 1933 was actually declared unconstitutional, but it established a principle that would survive, that workers had a right to organize and bargain collectively. This was codified permanently in the National Labor Relations Act of 1935, also called the Wagner Act, which guaranteed workers the right to form unions, required employers to bargain in good faith, and created the National Labor Relations Board to enforce these rights. This was revolutionary. For the first time in American history, the government was actively supporting unions rather than helping employers crush them, and unions grew explosively, from less than 3 million members in 1933 to over 15 million by 1945. By the 1950s, about a third of American workers were unionized, and even non-union workers benefited because employers had to compete with union wages and benefits. This shift in bargaining power is crucial to understanding how the middle class was created, because it meant that productivity gains would be shared with workers rather than accruing entirely to capital. When the post-war economy boomed, workers captured a meaningful share of that growth through wage increases and benefits, creating the first mass middle class in history. The Social Security Act of 1935 created the framework for the modern welfare state, establishing old-age pensions, unemployment insurance, and aid to dependent children. Before Social Security, most elderly Americans lived in poverty, dependent on their children or charity. After Social Security, they had a guaranteed income. This wasn't just humanitarian. It was economically transformative because it meant elderly people had money to spend, supporting demand for goods and services, and it freed younger workers from the burden of supporting elderly parents, allowing them to spend more on their own families. Unemployment insurance similarly stabilized the economy by maintaining spending during recessions. These automatic stabilizers, as economists call them, meant that economic downturns didn't spiral into depressions the way they had before, because even unemployed people had some income to spend. The welfare state wasn't socialism or a handout, it was economic infrastructure that made capitalism work better by maintaining demand and reducing desperation. The Fair Labor Standards Act of 1938 established a minimum wage, guaranteed overtime pay, and restricted child labor. These seem like basic protections now, but they were bitterly opposed by business interests who argued they would destroy the economy. Instead, they helped create prosperity by ensuring workers earned enough to be consumers. Henry Ford had understood this principle decades earlier when he paid his workers enough to buy his cars, but most employers needed to be forced to do it. The minimum wage created a floor, ensuring that even the lowest-paid workers had some purchasing power. Overtime pay discouraged employers from working existing employees to death rather than hiring more workers, spreading employment more widely. And restricting child labor meant kids stayed in school longer, creating a more educated workforce that could handle the skilled jobs of the mid-20th century. Again, reforms that seemed radical and dangerous at the time turned out to enable prosperity. The New Deal also invested heavily in infrastructure and direct job creation. The Works Progress Administration employed millions to build roads, bridges, schools, parks, and public buildings that still serve us today. The Tennessee Valley Authority brought electricity to rural areas through massive dam projects. The Rural Electrification Administration extended power lines to farms. These weren't just relief programs to give people something to do, they were investments in the productive capacity of the economy. Rural electrification alone probably added several percentage points to GDP growth by making farms more productive and opening rural markets for consumer goods. And the WPA projects created infrastructure that facilitated commerce and improved quality of life for generations. A school built in 1936 might educate children until 2000. A bridge built in 1938 might carry traffic until it's replaced in 2010. These investments had returns measured in decades, and they were made possible by the Depression because nobody worried about deficit spending when a quarter of the country was unemployed. World War II often gets credit for ending the Depression, and it's true that the war brought full employment and massive industrial mobilization. But the war also cemented and extended New Deal reforms in crucial ways. The War Labor Board, which mediated disputes to prevent strikes that might hamper war production, generally sided with unions, helping them grow and gain legitimacy. Wage and price controls during the war led employers to compete for workers by offering fringe benefits like health insurance and pensions, since they couldn't offer higher wages. This created the employer-based health insurance system that still dominates America, which has problems, but at the time massively expanded access to health care. The GI Bill, passed in 1944, offered returning veterans funding for college, vocational training, and home loans. This was the most significant educational expansion in history. Millions of men who never would have attended college did so on the GI Bill, creating a highly educated workforce that drove post-war innovation, and the home loan sparked a housing boom and enabled a generation of veterans to build wealth through homeownership, turning America into a nation of property owners with a stake in the system. The post-war settlement between labor and capital, sometimes called the Treaty of Detroit after the landmark 1950 contract between the UAW and General Motors, represented a fundamental shift in how capitalism distributed its gains. Unions accepted the basic capitalist framework: no nationalization of industry, no worker control of production. But in exchange, they got steady wage increases tied to productivity, comprehensive health insurance, pensions, job security provisions. This wasn't charity. It was enlightened self-interest. Executives recognized that well-paid workers were customers for their products, that labor peace was worth sharing profits, that a prosperous working class created political stability. And for about 30 years, roughly 1945 to 1975, this settlement worked incredibly well. Real wages rose steadily. The median family income doubled. Poverty rates fell dramatically. More Americans owned homes than ever before. College attendance soared. The gap between rich and poor narrowed to its lowest point in American history. The top marginal tax rate was over 90% for much of this period. Yet the economy grew faster than it has in recent decades. Productivity and wages grew in lockstep. When workers produced more, they earned more, creating a virtuous cycle. The suburban expansion of the post-war decades, often dismissed as conformist and environmentally destructive, was actually a massive wealth creation program for the middle class. Government-backed mortgages through the FHA and VA made homeownership accessible to people who never could have afforded it before. The interstate highway system, another massive government investment, made suburbs practical by connecting them to jobs in cities. And as homes appreciated in value, homeowners built equity, creating wealth they could borrow against or pass to children. This wasn't available to everyone. Discriminatory practices like redlining excluded Black Americans from much of this wealth creation. But for white working-class families, homeownership was the primary mechanism for building wealth and entering the middle class. A factory worker could buy a house, pay it off over 30 years, and retire owning an asset worth several times what he paid. Meanwhile, his union job provided a pension, and Social Security provided a safety net. This security enabled a lifestyle where one income supported a family, where people could take vacations, send kids to college, retire with dignity, where economic anxiety, while not absent, was much lower than today. The expansion of public education was another crucial component of middle-class creation. High school graduation rates soared. College attendance expanded from an elite privilege to a middle-class expectation. States invested heavily in public universities that charged minimal tuition. California's Master Plan for Higher Education, adopted in 1960, guaranteed spots in the UC, Cal State, or community college system to all qualified students, essentially for free or nearly free. This was a massive subsidy to the middle class, allowing social mobility through education. A truck driver's son could become an engineer, a factory worker's daughter could become a teacher, and the expanding educated workforce enabled the shift from manufacturing to services and technology. The investments in human capital made during this period paid dividends for decades. The creation of Medicare and Medicaid in 1965 completed the New Deal welfare state, ensuring that elderly and poor Americans had access to health care. This was economically significant because medical bankruptcy had been a major cause of families falling out of the middle class. A serious illness could wipe out savings and leave families destitute. With Medicare and Medicaid, that risk was reduced. The safety net was more complete, and notably, life expectancy increased significantly as more people had access to medical care. Again, this wasn't just humanitarian. It was economic. Healthier people are more productive, and reducing the fear of medical bankruptcy allowed people to take more economic risks, starting businesses or changing careers, knowing they wouldn't lose healthcare in the transition. The irony is that many of the people who fought hardest against New Deal reforms later benefited most from them. Business leaders who predicted that Social Security would destroy capitalism later retired comfortably on their pensions and Social Security checks. Employers who said minimum wage would cause mass unemployment hired more workers when consumers had more money to spend. Bankers who opposed FDIC deposit insurance saw their industry stabilize and grow. The reforms that seemed radical and dangerous at the time turned out to enable the most successful period in American capitalism. The 1950s and 1960s saw sustained growth, low unemployment, rising wages, expanding home ownership, and broad prosperity that far exceeded anything achieved under laissez-faire. The invisible hand worked better when government set rules and provided stability, when workers had bargaining power, when a social safety net caught people who fell, when demand was maintained through transfer payments and public investment. But the middle-class prosperity built on the ruins of the Depression didn't last. Starting in the 1970s and accelerating in the 1980s, the post-war settlement began to unravel. Unions were attacked and declined. Financial regulations were weakened and eventually repealed. Top tax rates were slashed. The minimum wage stagnated. Social spending was cut. Public universities raised tuition. The link between productivity and wages was broken, and inequality began rising again, approaching levels not seen since the 1920s. Why did this happen? How did we lose what the Depression had forced us to create? The reasons are complex, involving globalization, technological change, demographic shifts, and deliberate political choices. But a crucial factor was that the generation that remembered the Depression died off, taking with them the visceral understanding of why regulations and unions and social insurance mattered. Younger generations, especially elites who benefited from existing wealth, came to see these institutions as constraints on growth rather than foundations of prosperity. The ideology that had been discredited in the 1930s made a comeback, repackaged as free market economics and supply-side theory, arguing that reducing taxes on the wealthy and weakening unions and deregulating finance would unleash growth that would benefit everyone. And for a while, by some measures, it did produce growth. But it was growth that accrued overwhelmingly to the top. Median wages stagnated even as GDP rose. The middle class stopped expanding and began struggling. Jobs that once paid middle-class wages were either automated or sent overseas. The new jobs and services often paid less and offered fewer benefits. Housing and education and healthcare, the pillars of middle-class life, became increasingly expensive, requiring debt rather than being affordable on a single income. The security that characterized mid-century middle-class life vanished, replaced by anxiety, precarity, and the sense that the next generation would be worse off. We're now further from the Depression than the Depression was from the Civil War, and the lessons have been largely forgotten. The institutions and policies that created the middle class are seen as outdated relics rather than proven solutions, and so we drift toward a new Gilded Age with levels of inequality and instability that echo the 1920s. The lesson of how the Depression created the middle class is that catastrophe can create opportunity, but only if the political will exists to fundamentally restructure institutions and redistribute power. The crash didn't automatically produce the New Deal. It created the political space where the New Deal became possible, but it still required leadership willing to experiment, movements pushing for change, and enough suffering that the old order couldn't maintain its grip. Roosevelt's famous quote was that he welcomed the hatred of economic elites. They are unanimous in their hate for me, and I welcome their hatred. Because he understood that creating broadly shared prosperity required taking on concentrated wealth and power, and he had the political mandate to do it because the Depression had delegitimized the people who had created it. The bankers and tycoons who had been heroes in the 1920s were villains by 1933. Their ideology was bankrupt, their predictions had failed, their system had collapsed, and this allowed for fundamental change that wouldn't have been possible in normal times. Today we face challenges that in some ways echo the Depression: extreme inequality, financial instability, technological disruption, climate change, democratic backsliding. And there are regular predictions of coming crisis, the next recession, the next financial crash, the climate catastrophe. And perhaps these crises will create opportunities for transformation the way the Depression did. Perhaps suffering will again break the grip of failed ideology and allow new institutions to emerge. But that's not automatic. It requires political mobilization, leadership, and the will to learn from history rather than repeating it. The Depression created the middle class not through some natural process, but through conscious policy choices made by people who understood that capitalism needed to be reformed to survive, that leaving workers desperate and powerless was not just cruel, but economically stupid, that inequality beyond a certain point was destabilizing, that markets needed rules to function properly, that government had a responsibility to maintain demand and provide security, and these insights, paid for in the suffering of the 1930s, enabled the prosperity of the 1950s and 1960s. But we've spent the last 40 years systematically dismantling what was built then, and now we're learning once again that unleashing markets without constraint, weakening labor, cutting social insurance, and allowing extreme inequality produces not prosperity, but instability, not broad middle class flourishing, but an increasingly desperate majority serving a wealthy elite. The same pattern that led to 1929, and perhaps the same pattern that will eventually force another restructuring, another New Deal, another moment when crisis breaks the old order and creates space for something better. But there's no guarantee. Crisis can also lead to authoritarianism, to scapegoating, to the violent defense of privilege rather than its redistribution. The Depression created the middle class in America, but it created fascism in Germany. The same crisis, different responses, different outcomes, and which path we take next time depends on whether we've learned the lessons of how the crash that destroyed the Roaring '20s became the foundation for the most prosperous and equitable period in American history, a period we're still living off even as we dismantle it, hoping apparently to discover once again what happens when you concentrate wealth and power to extreme degrees, leaving the majority insecure and angry. An experiment we've run before with predictable results that we seem determined to reproduce.